The other item I want to mention is profit margin and asset turnover are inversely related. The higher your profit margin, the lower your asset turnover, and vice versa. And the reason is this, it's different industries basically have different profit margins and asset turnover. So let me give you an example. If you are at Dominick's and you're selling your grocery items, those are going to sell very quickly. You're going to have very low profit margin, but a huge asset turnover. If you are a high-end jeweler selling $1 million diamond, you're going to have very little asset turnover, but very high profit margin. So they're going to always work inversely. Okay. The next item is ROA, which is return on assets. And again, net income, if you look at on the sheet, you'll see, and we're always looking at the current year. The only reason we look at the last year is if we're doing an average. Other than that, we're always looking at the current year. So here we're going to take our net income, divided by our average assets. So we're looking at our assets for this year plus our assets for last year and dividing that by 2. We end up with 6.7%. Net working capital. That's just our current assets minus our current liabilities. So how much more do we have in current assets than we have in current liabilities? Okay, that's all that's telling us. Current ratio is our current assets divided by current liabilities. So what this tells us is we have 2.7 more in current assets than we do in liabilities. And again, is that good or bad? It really depends on the industry, and it depends on where you are as a company. You might have too much in current assets. That would be a problem. So this is all going to be dependent on where your industry is and where you as a company are. If you have too much in current assets, then what might be occurring is that you're really not utilizing your assets well enough. Okay. Your liability to equity, again, we're taking our total liability figure and dividing it by our total equity figure. And it is 0.56 to 1, which means we have about 56 cents in our total liabilities for every $1 of equity we have. Average collection period is our average accounts receivable. So it's our accounts receivable for this year and last year, and then divided by 2. And we divide that by our sales, divided by 365. That's considered how many days there are in the year. So when we go through that calculation, it's 36.5 days. That tells us that on average, it takes us about 36.5 days to collect our accounts receivable. And, that sounds pretty good to me, but it depends on the company, it depends on the industry, it depends what your goals are. Next one is receivable turnovers. What that's telling us is how many times during the year do we collect, on average, our receivables. That's just our sales divided by our average accounts receivable, which we already figured out here, so we can just pull that number over. But that means we collect them about 10 times during the year, which would be consistent with 36.5 days. Next one is number of days sales and inventory. That's our average inventory, so our inventory from this year plus last year divided by 2. And we're going to divide that figure by our cost of sales divided by 365. So that's about 119.9 days. That's how long, basically, it takes us to sell our inventory. Now, that might be something that this company needs to work on, but again, it depends on the industry, and it depends on the company as to whether or not that figure does need to be worked on. Last thing is how many times during the year, inventory turnover, how many times during the year are we basically selling our inventory? That's going to be our cost of sales, which we've already figured out, $175,000 divided by our average inventory, which we figured out here, $57.5. So basically, 3 times during the year we sell inventory. Again, at first glance, it looks like it's something that should be worked on, but again, it's peculiar to the company and to the industry, if that's good or bad. Maybe they've been getting better over the time, so that might be a good thing. The next thing that I want to tell you about real quickly is that when you're not going to have to calculate any of this yourself. None of this has to be calculated. And I apologize, my phone is ringing, so just ignore my phone. But you're not going to have to calculate any of this on your own. When you're doing the assignment, you're going to simply take it from the PDF file, those figures, and just put them into the template, and it's going to calculate all these ratios for you. Okay? So you're more interested in knowing what's going on behind those ratios. Okay, the next thing that I want to talk about real quick is depreciation. I'm just going to go over that really fast. Let's say there's 3 things you need to know to calculate depreciation. And let's assume we're just going to do straight line depreciation. You need to know the cost of the item. You need to know how many years you're going to use, or how many periods or years you're going to utilize it for, so the time. You need to know the salvage value. So let's say I buy a desk, and the cost of that desk is $10,000, and I'm going to use it for 4 years, and my salvage value is $2,000. And what that means is at the end of the period, somebody's going to buy it, for example, for $2,000. That's how much it's worth at the end. The way I would do this, and again, this is straight line, I'm going to take my cost, subtract my salvage, and divide it by the number of years. So that would end up being 8,000 divided by 4. Each year, I would depreciate $2,000. So that means every year on my income statement, I'm going to depreciate $2,000. On my balance sheet, every year I'm going to add $2,000 to accumulated depreciation. So if I, for example, bought this on January 1st, on my balance sheet, at the end of December of, say, 2013, I'd have accumulated depreciation of $2,000. I'm going to keep a running total of this. So at the end of 2014, my accumulated depreciation would be $4,000. So every year it would be increasing by $2,000. This is called a contra asset account. It reduces my asset accounts. So although I would call this equipment perhaps on my balance sheet, I'd have total equipment. It cost me $10,000. But if you look, what's the book value of that equipment at the end of year 2? $6,000. It's the equipment minus my accumulated depreciation. Okay? So again, every year, balance sheet or permanent accounts, it's going to always stay there. On my income statement, I have temporary accounts. We close those out at the end of the year and start over again. Balance sheets are permanent. It's a picture, a snapshot at one point in time. Income statements are going to close out at the end of the period. They're for a period of time. So on my income statement each year, 2013, 14, 15, every year I have this equipment, this desk, my depreciation expense is going to just show $2,000. Okay, it's not a running total. It just shows the actual amount of expense I incurred for that year. So hopefully this gives you kind of a picture of what's going on. If you have any questions, feel free to call me. Again, this is due, this assignment is due this week. If you do have a question, if you're confused, feel free to call me at any time, or if you want to send it to me at least a day before it's due, you can do that and I can go over it and tell you if you need to change anything. But hopefully this gave you enough information that you're able to complete the assignment and understand a little bit about what's going on. We're going to just get a cursory overview probably in a lot of this because it is only 5 weeks and we're covering a lot of things. But hopefully at least you have some idea of general accounting. So I will see you again next week.